We've gone from meltdown to melt up in just a matter of 3 months. Seems like right now we're seeing a little bit of consolidation. Is this rally looking a little bit tired to you?
Hi, morning, Yvonne. So from our perspective, we actually think there are three things which the market really needs to continue going higher from here for the second half. First is ample liquidity from the central banks. We've seen that come through from the Federal Reserve. Dollar liquidity remains fairly ample in the markets. And, you are seeing continued fiscal support as well. And second is really the safe reopening of countries. So if the fundamental data continues to improve from here, and we've already seen PMI readings, earning revision ratios pick up. So the data we're looking at, Eastspring, we actually think the market can continue going up from here in the second half.
But some say there are some crowded trades out there. There's also a bit of a liquidity risk that makes these markets fragile. You don't agree with that, Nupur, in any way?
Yeah, I mean, look, there's always going to be risks. And I think from our perspective, the biggest risk is the fact that is if the second wave becomes a bit more entrenched. But from the point that we're looking at the markets, we actually think the fundamental data is improving. So there are legs to this rally. And if you look at equity sentiment, it doesn't look as stretched, particularly for global markets. And also market breadth, which is just the broadening out of, the rally itself has improved over the last few weeks. So there can be some wobbliness, and we would imagine that markets remain volatile over the next couple of months as we get through this crisis. But overall, we think that if policy remains supportive and liquidity remains ample, then fundamental data really seems to have already displayed a V-shaped recovery from our perspective.
Nupur, you say that fundamentals are supportive, but there's little clarity on how the economy will shape up from here, how it will recover from here, lack of clarity in terms of earnings outlook as well. Some say that perhaps companies are navigating in the dark. I mean, what's the risk that you could be wrong with that fundamentals are supportive?
Yes, I think it's very important to keep a very close eye on really high-frequency data. We really can't rely on, just monthly data anymore. We're tracking data on a weekly basis in terms of the jobless claims, which comes out later this evening, along with any earnings revision ratios, which comes out on a weekly basis as well. And in fact, if you see U.S. markets, analysts are now upgrading more than they're downgrading. So we think that that's pretty positive from a fundamental standpoint. So what I would say is the main risk to our view is if the second wave becomes more entrenched, leading to a potential re-lockdown of countries and economies, then that would become a much larger risk, and our positioning would have to be positioned accordingly. The other thing which is probably really worth highlighting over here is that if you look at Asian markets, particularly North Asian equities, which are quite geared to the global economic cycle, earnings revision ratios are improving over there, and consumer data is also picking up. Whether you look at auto sales in China, or whether you look at industrial production data, which came out earlier today from the region as well. So we are starting to see that fundamental data really come in. So if you do get a second wave, then a lot of this can stop. But otherwise, we're still quite positive.
Bonds pricing in uncertainty, stocks pricing in perfection. Do commodities offer the closest indication of the real economy, you think?
So commodities, I think, particularly if you look at oil, are really it's really more about the demand and supply mismatch. So obviously you've seen a pretty large demand shock, and in response you've seen some supply cuts. But the oil market is really not able to figure out at the moment which of those are dominating or will dominate, given the uncertainties on demand going forward. So actually I would say equity markets are probably, again, to us, we don't think it's overvalued at the moment. And like I was mentioning earlier, equity sentiment is still not stretched. So we actually do think that equities are probably giving you a pretty good indication of what may come in the second half. Of course, from the bond side, we probably have a contrarian trade on there where we are short duration. And again, a lot of that hinges upon the fact that we think short-end rates will probably remain anchored, given the fact that the Federal Reserve has been very clear that QE is here to stay at least for the next 1 year. On the other hand, your back-end rates and your long-end rates, which are typically reflective of the economic trajectory, as you start to see fundamental data trickle in, we would imagine the yield curve to steepen from here. So I think what's important, to highlight is that even from a portfolio context, it's very important to have barbell strategies and any effective hedges in place. At Eastspring, we are ensuring that we remain nimble, we diversify across, asset classes. And, from that perspective, a multi-asset portfolio does appear as being quite attractive because you can choose areas in the markets which are not appearing as to be as frothy and are actually backed by fundamentals.
Yeah, we were just talking to a guest yesterday, Nupur, about how there's just not that many alternatives out there. He says gold is still the biggest risk diversifier out there. I mean, what are the best things that you look at in terms of that barbell strategy now?
Sure. So I would say the dollar is definitely a big one. It has trended lower over the last few weeks simply because you are in a risk-on environment at the moment, but it acts as a pretty good risk-off hedge. And also, certain ways could also be from the credit perspective, particularly in Asia, where you have policy support for Asian high yield coming in from Chinese policymakers as well as others, that having these high yield strategies within the portfolio where credit spreads are still quite wide can act as a good barbell strategy to just being long equities.